What's going on, everybody? This is Travis Witherspoon from Carter Cow Capital. This is your Forex traders tip for today. And I want you to be able to understand this. This is very important. I'm going to say this statement and it's going to end up making sense after a while. If there's no momentum, then there's no movement. If there's no movement, then there's no trade. Okay, now what do I mean by that? If you're looking at a currency pair and you're starting to see that the market is actually getting into your overall position of where you would like to be able to take the trade. If there's not a lot of people basically trading and thinking the same thing that you're doing, if there's not a lot of smart money back behind on what you're thinking about for your overall trading, then the market is not going to end up going the way that you want it to go in the time frame that you may think that it's going to end up going. Right. So it's very important to be able to use indicators that tell you momentum. One of my favorite indicators to be able to use is the average directional index. The reason why I like the average directional index so much is because that they have a value where the number is basically to where you end up seeing when the number typically gets above 20, you start to see more momentum in the market to see that there's actually going to end up being a little bit more volatility. Right. Volatility drives the market, which means that a lot of people getting into a trade at one time will end up skyrocketing the market to the overall direction that you wanted to go, whether if it's bullish or bearish. So being able to understand how to be able to read a average directional index indicator or a momentum indicator will allow you to be able to say, okay, there's momentum in the market or there's momentum that's coming in the market. If I get into it early, then that means I can be able to reward myself by being in early, by staying into it just a little bit more, because there's going to be more buyers actually getting into the price. Now, understand that can happen on the back end as well. Typically, if you look at a momentum indicator like the ADX, typically when the market goes up to 20, then that means that the market is actually moving and there's a lot of momentum in the market. Now, remember, when there's momentum, there's movement, right? When there's movement, there's a trade to be able to get into and actually be able to stay into it. Typically, when the market basically goes up to right around the 40 area on that indicator and starts to be able to turn over, then you can see that the overall move that it end up making, whether if it was bullish or bearish, will start to be able to turn over. And now the opposite group will end up having that trend and will start to end up having that overall movement, which means that you'll probably end up seeing a retracement in the market. So by being able to see that and understanding that, well, the market has started to move, we're starting to get a very good push, we can be able to ride it out and go into that pair. That'll allow you to be able to get into the market and know you can stay into the market until the momentum is starting to be able to wane down. Now, when the market basically turns back over and starts going back to 40 and going back below it, so you're talking about 30 to 20 to anything else like that, now you can see that the momentum is being taken out and you can see that other people are trading to the opposite direction of what you're actually doing. So keep that in mind. When there's no momentum, there's no movement. If there's no movement, then there's no trades. So you look at you look back at that indicator, you see that the market is at 0 to 10, then there's no reason to get into that pair yet, right? And if you look at a long-term time frame, kind of like the daily, well, you can be able to see that if you place it up on a chart and you look at all of the other currency pairs and you just look at what their numbers are, if you can see that the market is actually at a point to where the numbers are basically at 18 to 19, getting very close to 20, or at 21, possibly 22, then you could possibly see more trading opportunities from there, as long as the market is in that overbought or oversold position where you can be able to get the most out of that position. Remember, time frames allow you to be able to move yourself into it and stay into a trade for as long as you need to within that pair, right? On the daily, typically when you're seeing a oversold or overbought area, it's going to take about 7 to 11 days. If it's on a weekly, that's about 2 months of actual movement, right? So you can allow yourself to be a little bit more patient and allow yourself to be able to stack up on that trade while it's actually doing what it's supposed to do. Now, if I provided any value for you in this overall video, please make sure that you end up liking, sharing this to somebody that you think that will be interested in being able to learn a little bit more about what we end up doing. You can go to cartercowcapital.com/start here to be able to get some mentorship and actually hop into one of our free webinars. We actually end up holding a free 5-day workshop for people that actually end up asking for it, right? I'm not going to come out to you and say anything. If you ask for it, then we actually end up holding it. So we actually end up doing that. But until then, I'll see you tomorrow for the next Traders Tip.